What's going on, guys? This is Will from Market Risk Trading, and today I am here to go over with you guys Beginner's Guide to Technical Analysis. Now, this is some of the strategies in technical analysis for beginners you could use to kind of get your feet wet, to kind of build an understanding on how to use uh, technical analysis along with your fundamentals to get better entry and exit points, whether you're a short-term investor or a long-term investor. So, welcome, guys. Here we go. Most people, when they first invest in the financial market, they kind of focused on fundamentals. When I first started myself, that's what I did because I went to school for that. So I went into evaluation of stocks, are they profitable, go over the financial statements, look at their balance sheet, go over their cash flow statements, seeing how they're generating their revenues, made comparison, did DCF analysis in terms of industry trends, comparing company within the same industry to see if they're underperforming or outperforming each other to find a better investment, right? So like if you're a long-term investor, fundamental is the way to go because you do want to know where you're putting your money into. Does this company have value? Does it have growth? Within 5 to 10 years, can I double my money? Can I triple my money? Right? That's where you kind of want to go into in terms of, okay, what does this company offer me? Like, why should I put my money? Why should I invest in it? When you're looking at the earnings per share, is it forever growing? When you're looking at the PE ratio, are they trading are they trading 20 times, 50 times their earnings? You kind of want to go into those things. Those are those fundamentals part of it. Now, as for the technicals allow you to take advantage of a day-to-day movement in the stock price itself. This is where it comes in. Because to be honest with you guys, fundamentals, they don't always reflect market price. On the other hand, technical analysis does because it tracks historical data. It studies the company price and volume. So it helps you predict a price. Now, for beginners, you should understand what technical analysis acts as a gateway into consumer dynamics to profit opportunities in terms of being successful in the market, psychologically speaking, right? So this is why anybody that knows me, I always talk about building a strategy, practicing risk management, and disciplining yourself, right? Because in that way, if you have a specific trading method and you've done the research, you've done your due diligence with the technical analysis, you can execute without interfering with your emotion or second guessing yourself, guys. That is really, really, really important because a lot of people, they do that all the time. They do that all the time where they don't study the trade and they just want to go in. And, it goes against them. They cut in losses. Next thing price fluctuates up and down. You get scared. Your emotion is tied up. You don't know how to think. Like, I really do think that trading is really a misunderstood endeavor, right? Because you're not trying to trade to beat the market. Instead, what you should be doing is you should be placing low risk, high reward trades, right? That way you could have acceptable probabilities of being successful in the market. And you just do it time and time again. You're collecting 1-2% every time. You do that 10, 20 times in 2 days, you're already beating the S&P because the S&P averages about 19 to 20% a year return on investment. So with that being said, guys, it's all about strategy and you have a skill. And sometimes things may really go your way where you find you're waking up, you're making 1,000% return on equity, return on investment. So, but with that being said, again, it is essential that you do understand technical analysis. So today with what we're going into is just to kind of get your feet wet so you can start better understanding, right, technical analysis, and hopefully you get deeper into it. Now, first off, we're going to go over the two main approach to technical analysis. There are the top-down approach and there are the bottom-up approach. So most of the time, short-term traders, day traders like ourselves, will be using a top-down approach, while a long-term investor may want to use a bottom-up approach. Now, why is that? Because one focuses on the companies itself individually, and the other one focuses on the, what you would say, domestically and globally economically. Just kind of find out how other economies are doing, and you're comparing it to yours right now. So now let's get into the definition of that. So the top-down approach is one that examines the economy as a whole before focusing on the individual stocks. Now, this is what I mean in terms of doing your due diligence, doing your homeworks, because you know what the economic activities are. Now you can dumb it down to the sectors, see how your company are underperforming or performing, overperforming companies within that same sector. Then you want to come dumb it down to the companies itself, right? Just to kind of see what headline moved this company, or how are they impacting it negatively or positively, right? On the other hand, bottom up. As opposed to a macroeconomic view, the bottom up approach focuses on individual stocks, right? That includes evaluating the stocks that appears fundamentally strong or important for possible entry and exit points. So as an investor, if you were paying attention to the market, when the stock market dropped from February 20th, by the 23rd of March, it bottomed out. Now, had you got used to technical analysis, you could have found an undervalued stock on a downtrend, use your technical analysis, find out when it bottomed out, and you have a specific entry point. Right now, you would have been lavish. That's the one word that I like to use in terms of when you catch a nice entry, you're pretty lavish, because right now all those stocks are more than 25% of their lows. The whole market is 50% from March 23rd lows, right? If you look at Apple, if you look at Facebook, if you look at Amazon, they all bottomed out at the same time, and not all those stocks are hitting all-time highs, guys. Now, before we kind of want to get into uh, certain technical analysis, like I said again, these are just the basics. We kind of want to understand stock charts. What are they, right? A stock chart is simply a visual representation of a security's price or index over a set period of time. Any stock or security over a period of time that includes price data can be used to shape a map for analysis. Now, there are three main common chart types that people use. Technical analysis uses varieties of charts, right, to analyze price movement. The three main ones that I think they use the most, number one is line charts, which we see a lot of mutual funds website. If you go there, you see mostly line charts. Second one is bar charts, and the third one is candlesticks. Now let's get into line chart. This line charts here, guys, are basically used to get a big picture view of price movements, right? It is formed by connecting the closing price over a specified time frame. Some investors and traders consider the closing level to be more important than the open, the high, or low. So by paying attention to only the close, intraday swings can be ignored. Now, let's move into bar charts itself. Okay, now guys, this is a bar chart you guys are looking at. The only thing I like about this bar chart is because it tracks daily volatility. Besides that, I do not use it. And again, if you do choose to use it, if you have a system, a strategy that works for you, if it's not broken, don't fix it, right? Now, like I said, I like the fact that it tracks volatility. Now, the open, high, low, and close are required to form the price plot for each period of a bar chart. The high and low are represented by the top and bottom of the vertical bar, which are these here. The open and close are represented on the vertical line by a horizontal dash. Now, the opening price on the bar chart is illustrated by the dash that is located on the left side, and the close and the high is represented on the right side over here. Now, again, the only thing I really like about this is because it can show volatility. And now moving on to my favorite, which is a candlestick chart. And Phil, I believe, went over this with you guys just to kind of teach you guys what are the opening of a candlestick, what is the body, what are the wicks, or what are shadows, right? So candlestick charts, they're pretty similar to bar charts. in that they provide the same information that you're looking for, but just in a different format, guys. So the candlestick is constructed using horizontal lines to indicate the open and close, and a vertical box is made connecting these two lines to form the body of what we call the candlesticks. Now, a single vertical line is drawn in the middle of the box to show the high, and vice versa, the same one is drawn below the box to show the low. Now, these are known as wicks or shadows. Now, the next difference that you may notice on the screen is the color difference, right? Whether it's filled or not. So in traditional candlesticks, if the close is higher than the open, then the body is left green. This is what you're seeing here. This is a positive day. It's an up day. Vice versa, if the close is lower than the open, the body is closed. So you depend on where you're doing your chart analysis at, it may present itself as black or red, but that indicates a down day. Now, let's move into understanding basic concepts of trend. Now, as day traders, you might use simple trend lines and volume indicators to make decisions. Swing or position traders may prefer chart patterns and technical indicators. But honestly, both can be used for both styles of trading to track the overall trend of your stock or security. Now, trend is the direction of price moving based on where they've been in the past, and they made up peaks and troughs. Now, whether you're on an uptrend or you're on a downtrend or you're consolidating sideways, they all indicate the direction of the trend. Now, let's look at an uptrend. This is an uptrend here. It's made of ascending peaks. This is the first one. The second peak should be higher than the first. So is the ascending troughs. The second one should be higher than the first one. So this is made of higher highs. This is a high and this is a higher high. This is a higher low. This is a high. This is a low and this is a higher low. Now it's being connected between two or more low points, as you guys can see in the chart. But the second low must be higher than the first in order to have an upward trend. Now we have the diagonal line here, the green line acting as support. Now just keep in mind as I'm going over this, demand means buy zone, supply means sell zone. So in the event that the stock or the company you're trading breaks below this trend line, this diagonal trend line, that may indicate that, okay, a change of direction in the trend is near, right? You might want to take your profit. Now, if you got in here, here would be a good place to take profits in terms of risk management, right? Then you could roll it over. Then second point would be right here. And then you get out and there's possibly going to be a change of event of trends in the stock, right? Now let's get into downtrend. So a downtrend is completely the opposite of an uptrend. Of course, it is made up of descending peaks and troughs, right? So as you can see here, these are the descending peaks, and these are the descending troughs. We have a lower highs and we have lower lows, right? It's on a downtrend. Connects two or more points, just the same as we connected on the uptrend itself. Now, that's when the sellers are coming in hard. And, if you're shorting a company or you have a put position on the stock itself, right? If you got in over here, here would be a nice place to take profit, right? A nice place to take profit in terms of you really going by the risk management or you're collecting that 1 to 2%. Now, in the event that, the stock break above this trend line here, we might want to go long on the stock. It could be temporarily, it could be on a short term, or it could be a nice run from there. But again, you always want to manage your risk properly, right? But this is how you could draw a trend line just to kind of follow through with it, right? The company that you're trading. Now, guys, this is when a stock consolidates. It moves sideways. As you can see, it's staying in between those ranges here. This here could be known as the resistance, and this here could be known as your support. This would be a demand zone, and this would be a supply zone. This would be a buy zone. This would be a sell zone at that point. And at the same time, just kind of knowing, okay, whenever it hits a resistant price, it gets rejected. It hits it another time again, it gets rejected. At that point, you could see a chart pattern of a double top that you could use as well. Now, if the stock break below the support line, right, then you could really confirm a downtrend. That's when you probably would want to get in the trade, probably to short the stock and get out around these levels here at 420 in terms of managing your risk properly, right? Now we're going to use the same charts from before just to kind of show you guys support and resistance. They are important points in the chart where supply and demand meet. So support and resistance, like I said before, they can be breaking into supply and demand zone. What do I mean by demand? Demand can be viewed as support. This would be a demand zone, right? This is the level where demand is strong enough to stop the stock from falling, and you can have a nice entry. So let's say on this demand zone here, you could have entered here and exit here, and your second exit could have been right here because of that low pullback it had, but still went on an uptrend, right? Now, what do I mean by supply? Your supply is a sell zone. This is the supply zone right there. Gets rejected, goes back to the demand zone. Back to the supply zone, gets rejected, back here to the demand zone, right? The supply zone is literally the level at which supply is strong enough to stop the stock from moving higher. At that point, take profit. You could never go broke with taking profit, guys. Never, ever. But these are simple ways that you can set your support and resistance. During those time of consolidation, there's usually a breakout, right? But you might want to use other indicators in terms of your RSI, in terms of your MACD, and other oscillators that you use in order to confirm the trend. Also, fundamentally speaking, you kind of want to follow your company, the news that are coming out, the upgrades and downgrade of the stock itself, you know? Now, this is an example of support and resistance. How a support or resistance could become, how resistance can become your support or supports can become resistance. Now, over here, before the stock broke out to the upside, we had these levels here playing key resistance. As it broke to the upsides, those resistance became support, right? You could simply do it like that. Now, in terms of chart patterns itself, you can see a double bottom here. It bottomed out twice, and then we took off from 560 all the way to 697, right? But your support and resistance are just there to kind of guide you, okay, at your exit point or your best entry point. Now, your best exit point could have been here and get out over here. Then another exit point could have been here, could have stayed through it and get out over here, guys. Now, same thing as before. This is your prior support, and now it becomes your support. Again, stock was consolidating, trading in those ranges here. You could actually draw it so you could see. And then eventually it broke the neckline lower. And then now we have the stock testing resistance again, which was your prior support. It tested it twice, which is the second time. It jumps off of it, and now we're from $34 all the way to $30.50. Now, one of the basic form of technical analysis are the moving averages, right? So the moving average crossover strategy. With this, we're going to use a 10 moving day, 50, and the 200 moving day. Now, let's go into a little bit of vocabulary in terms of what a golden cross is or what a death cross is. So a golden cross is a bullish indicator as opposed to a death cross, which is a bearish indicator. A golden cross short-term 50-day moving average that goes above the long-term moving day average, which indicates an uptrend in the stock itself, and at that point can generate a buy signal for a trader like yourself. As opposed to the death cross, that's when the 200 moving average crosses the 50-day to the upside, indicating a downward price trend, and that could generate a sell signal. Now I want to take the time to kind of show you guys Facebook that we use, that we've been trading for quite some time now. So Facebook over here, we had a pretty a great bullish indicator, right? So guys, the purple line is my 50-day. Let me just show you guys here. So the purple line is my 50-day, the black line is my 10-day, and the 200-day is my red line. So, okay, just so you guys can know. So at that point here, guys, we had the 50-day crosses the red line, which is the 200-day, to the upside. Now, at this level here, this here was a nice buy entry point where you could have picked up the stock here on 173 and took it all the way to $240. Ever since then, this thing been on a constant uptrend. Every moving averages are trading at the current level, which means the 10 is up, then comes a 50, then comes a 200 moving day. Now let's see what a death cross looks like. A death cross looks like this, and we kind of seen this before the market dropped when a lot of stock was dropping. That is when the 200-day moves its place and trades above the 50 moving day average, right? So remember, the red line is the 200 moving day, and we have the 50-day being the purple line. So at that point here, we're seeing the purple line crossing the 200-day, the red line, to the downside, which is a sell signal. So as you guys could see, ever since that happened, we had a downtrend in the stock itself until we bottomed out, I think, around 137.10, and from there we took off. These are ways that you could possibly use the 10, 50, 200 moving day averages in order to get in your trades. Of course, right now, as you can see, I have the MACD here that I use as well. The MACD, I use it in terms of when the MACD crosses the signal line, I will possibly get in the trade, right? So if you guys were to look right over here, we had the MACD cross the signal line to the upside, and that kind of confirmed the trade for me to stay in as well, right? Now, in the event that it crossed the midpoint, which is the zero line here, that's why we had kind of confirmed the uptrend to the upside. This was a nice move here. We had here at 150 and all the way to 180, which is a $30 move within 1, 2, 3, 4, 5, within a week of trading. Within a week, 5 days of trading, guys. We had a 30 movement in Facebook from 150 to 180. Now, like I said before, I don't want to put too much on you guys, but these are the basic technical analysis that you could do. You could use the 10, 50 days, knowing how to draw support and resistance, knowing how to draw trend lines, as we just went over, just to kind of understand where you're sitting at. And guys, this is it. Thank you guys for being here. I do hope you guys take this and use it, right, on your day-to-day trading or even on your swing trade as well, just to kind of see your perfect entry and exit point. All right?
Thank you for watching. I hope you enjoyed and learned a lot from the video. Go ahead and smash that like and subscription button and follow us on social media for more content. And stay tuned for the next video.